Hello friends, today in this video we are going to discuss about the bank staff housing loan and how we model the cash flows in it. And you will also realize that being a bank employee, if you are able to borrow a housing loan in the staff category, how beneficial it is. And you are able to save a lot of money if you are a bank's employee as a staff in a staff housing loan, you are able to save a lot of money. So we will see how compared to a normal housing loan, a public housing loan, how a bank staff employee, when he or she avails a bank staff housing loan, how he or she is able to save a lot of money. So one of the perks of working in a bank. So suppose, so to start with, we are going to start with the public housing loan. So we are talking about the normal housing loan, and then we will venture out into the staff housing loan to look at the differences. Okay, so so this is the loan that the client or customer has taken of 200,000. The annual interest rate is 12%, so it works out to a 1% interest rate for the month. The tenure of the loan, for example, is 12 months. So generally the housing loans tenure is 20 years, 30 years, that is 240 months or 360 months. But even in such a short duration, there is a difference in the amount a customer pays when we compare a public housing loan versus a staff housing loan. So we'll model the cash flow for a normal housing loan, and then we will move to a staff housing loan. So the interest rate is how much? Monthly interest rate is 1%. Okay, I will type it down. Just a minute. I will type it down. 1%. This is 1 month. So we have to repay back the loan of 200,000 in how many months? We have to repay back it 12 months, a 1 year loan. The interest rate is 1%. What is the opening principal? The opening principal at the start of the first month is how much? It is 200,000. So, okay. Also, to help us, model in a more effective way, we will also, we have added another column of remaining months. So remaining months is what? At the start, it is 12 months. For the first installment, the remaining number of months are 12. And at the time of last installment, the remaining number of months at the time of last installment will be how much? It will be 1 month at the start of the last month. Okay. Now, for the calculation of installment, so I have told you the installment consists of principal and interest component. The installment consists of interest and a principal component. So to calculate the installment, we have an amazing formula in Excel, that is PMT. What is the rate? 1%. What are the number of installments? These are 12. Okay. Remaining number of installment. What is the loan? What is the opening principal? That is the loan for this specific installment. We will close it. Okay. Now, what is the interest component that has to be recovered? So it will be opening principal at the start of the month into the interest 1%. Okay. So using this interest component, we are going to deduct this interest component from installment to get the principal that is being paid in this particular installment. So closing principal will be how much? Opening principal minus the principal that has been paid in this specific installment. Now, opening principal for the second month will be what? The closing principal of the first month. Okay. Installment, again, I can drag this down. My interest component is how much? Is 1842. Principal component will be installment minus the interest component, and closing principal will be opening principal minus the principal component that has been recovered as the part of the installment. So we'll drag down all these formulas. We will get an amazing repayment schedule, an amazing flow of cash flows. Okay, so see, at the last, at the time, at this last point, how much is the principal that is pending? It is 0. But what amount the customer or the client has paid? He or she has paid 213,237, whatever may be the currency unit. Okay, and what is happening as a part of, so this is an EMI concept. So what is happening that in every installment, what is happening, the principal component is increasing and the interest component is reducing. Okay, and this concept of reducing principal, you can see the principal is reducing, is also known as what? Amortization of loan. Okay, now we'll move to modeling the staff housing loan, and you will realize how staff housing loan helps a particular bank's employee that has availed the staff housing loan to save a lot of money. So though when we are modeling a 1-year loan, the amount may be minuscule, but for a 20-year loan, 30-year loan, it's a big amount. It's a big amount. Okay, so again, now we will start from the beginning. So what is the opening principal? Opening principal is 200,000. Installment, again, see, installment, what we will do, we will take the same installment, but we will not calculate. We will take the amount here, same amount, so that we can compare apples to apples. Okay, what is the now with staff housing loan, you need to realize that the installment initially only impacts the principal. The installment is there to recover the principal portion only. The interest component, it accrues in a separate bucket. So the entire installment goes towards the recovery of principal. So closing principal will be opening principal minus the principal component. Okay, so the entire the entire installment is made up of principal component. It is in its entirety, it is impacting the principal, the outstanding principal. So closing principal has been reduced by the entire installment amount, but the interest accrues and it gets accumulated in a separate bucket for the in this staff housing loan for that particular employees. This will be opening principal. The accrued interest will be opening principal into the interest. Cumulative, I will tell you how the cumulative thing is acting, because at the end of the day you have to pay the principal. So the principal, so at the end of the time you need to pay the interest, and the accrued interest need to be cumulated therefore. So what is the total outstanding? Total outstanding is closing principal plus the cumulated accrued interest. So this will be the total outstanding at the end of the first month. Okay, now again I will mention down these months. Okay, interest rate is 1% for every month, and it can vary. You can vary it, but to make it simple and compare apples to apples, this we are doing. Now the closing principal of the first month is the opening principal of the second month. Again, the installment is what it is. So I will drag this down. The entire installment is the principal component. So closing principal is how much? Opening principal minus the principal component. The entire installment is made up of principal component. Accrued interest, we will drag it down. For cumulated accrued interest, we will take the accrued interest of the previous month and add the current accrued interest. Okay, and we will drag for total outstanding, we will drag down this formula. This is the accumulated accrued interest plus the closing principal. Again, we don't want the decimals here. Just a minute. Okay, now I will drag down these formulas. We will see how it behaves now. Okay, you can see how the closing principal is reducing, and you can see how the cumulated accrued interest is increasing. Okay, now we will further drag it down, we will see. Now we will drag it down 1 month by 1 month, to see how it is happening. You can see how the closing principal is reducing, how the cumulative accrued interest is increasing. Okay. Now, how much is outstanding at the end of the 10 month? This is the outstanding 22,000. Again, we will recover another installment. Okay. Now, what is the principal component? Now, the last installment, what is the principal component you need to recover? This is the principal. This entire thing you will recover. Okay. So, just a minute. So, the opening principal will be 4,533. This entire thing you will recover. Okay. What is the interest component? Now you have to recover all the entire accrued interest, the entire accrued interest. So this is the amount. So this interest component will be the accrued interest cumulated up till last month plus the accrued interest for this particular month. So the installment works out to, we will now for installment we will sum the principal component and the interest component. Okay, so installment is 16,805, and what is the total outstanding then? Total outstanding is, it is 0. So now what you can see is that what is the saving? So what is the last installment? It is 16,805. It includes the principal component that was remaining for this last month, the interest component, that is the entire cumulated accrued interest that has to be recovered, plus the accrued interest for the current month. And so now we will calculate the saving. The saving for the bank staff is the amount that a normal customer has paid minus the amount that has been paid by the staff. So this is the benefit for the staff. So this is an amazing thing that a staff of a bank enjoys. Okay, thanks.